On this channel, I always say to be careful of picking a stock just based on its high yield, as this can be a way to lure investors in and cover up poor fundamentals. But in today's video, I want to show you 3 stocks that not only have a high yield, but are also decent. The first company is a FTSE 100 British Australian mining company, and that is Rio Tinto. This company is responsible for mining copper, aluminium, iron ore, and more. They have one of the highest dividend yields in the FTSE 100, coming in at like 8.8% right now, which is extremely higher than average. If we look at their dividend annual growth, we can see that pretty much every year, apart from a couple of years from 2011 all the way up to now, they have been able to grow their dividends. And you can see a little bit of a clearer picture as been what's been happening down here. Now, if you hold Rio Tinto in your own portfolio like I do, you will know that it has been doing some crazy things recently. It's my best performing stock by far at the moment. It's managed to return me something like 20% since I first purchased into it, which is insane. But let's just have a look what it's been doing. So over the last 1 month, it's up by 7.6%. 6 months is, look at that, that's insane, up by 29%. Year to date, again, 7%. 1 year, it's up. 5 years, it's up. And if we max it out, we can see right now. What you can see is since sort of September time, it's just been on an absolutely crazy upward trend. And that's why I'm up by about 20%. It's been fantastic seeing this stock rise. And you can see that it's pretty much, I don't know about zooming in, but it's pretty much hitting all-time highs as well. So the question is, will this continue? And if you're wondering why this is actually happening, well, there's a few different reasons, but one of the main reasons is just the price link to iron ore. Of course, if a company has a really high dividend yield, then you do need to be prompted just to look a little bit extra into their financials, just in case there's something bad going on there. But what we can see is the top line of this business, so the profit, the revenue have been increasing. You can see year on year here, and the gross profit down here. The gross profit being the income after all costs have been deducted. So you can see that that's been going up and the total revenue has been going up. So the next thing that I'd be prompted to check here is their bottom line. So their net revenue, their net income, has that been able to increase as well? And you can see, yeah, it has been able to. If you look 2019 to 2021, so these 3, 8 to 9 to 21. That's a pretty big increase. So that is good to see as well. We want to be able to see that the company is not only able to make lots of revenue, make lots of profit, but we need to see what they're actually doing with that. Are they able to actually keep hold of lots of that money and, give it to shareholders, put it into the business, whatever? That's why we have to look at the top line and the bottom line and many other factors as well. We can see a couple of earnings per share here, EPS. You can see basic and diluted, and there is also an adjusted EPS too. But I just wanted to point out really high level stuff here. The EPS for both basic and diluted that we can see in front of us have been increasing. So this is indicating that this company is profitable. The earnings per share has been increasing. I don't think it's on here, but the debt to equity ratio of Rio Tinto is pretty good. I think it's something like 0% right now. Typically anything below 1 is insanely good, but the debt to equity ratio is just showing you to what degree a company can cover its debt. And it's not the only thing you should look at. You need to look at everything in totality, but the point is that if a company has loads and loads of debt, but they don't have much cash on hand, or they're not able to pay down that debt should they need to, obviously then in the future they might have to cut dividends to pay their debt or whatever the method. But it's something to look at. Have a look at their debt, have a look at their debt to equity ratio, have a look at their assets and their liabilities, their top, their bottom numbers. You want to look at it all. Going on to their balance sheet, we would see more information. A couple of things to point out here. You can just have a look at their liabilities. You can look at their long-term debt. I won't get into all of it, but yeah, just take a look at this. But the interesting thing here is the total cash is quite nice to see. That's been increasing. They've got cash on hand, but the free cash flow is what I want to point out. So right at the bottom here, we have operating cash flow, capital expenditure, and then the free cash flow in bold. And we can see that the free cash flow has been increasing by a substantial amount between this one to this one, but more so from this number to this number. Of course, a mining company like Rio Tinto or any other sort of mining company out there, They could be quite cyclical and you could have a lot of volatility in a stock like that. Rio Tinto is personally one I hold. I like having this company in my portfolio. But if you know any bad points or drawbacks to Rio Tinto that you want to leave in the comments below, please do. The next company that we have on our list today is not one I actually have in my own portfolio, but that is Primary Healthcare Properties, PHP. Unlike Rio Tinto, this company is on the FTSE 250. And we can see here that PHP invest in flexible modern properties for local primary healthcare. So this company is a REIT, a real estate investment trust. And we can just have a look at their portfolio here as well. You can see that their portfolio comprises of healthcare facilities that provide flexibility to meet the changing demands placed on primary healthcare services. So what you're going to see is you're going to see medical centres, local surgeries, you're going to see GP surgeries, places like that. I could scroll down this list, but as you can see, there are many pages here. As with the theme of this video, this company as well has a higher on average dividend yield, coming in at 6%. One thing to point out about this company is their massive dividend growth history. So we can see here, obviously there's been a couple of years where the dividend has gone down for whatever reason. You can investigate why, but just the general trend here, look at this. They're increasing their annual dividends every single year. And this to me is pretty impressive. For a company to be able to do this for as many years as PHP is highlighting that they must have good fundamentals, good financials. But of course, we're going to look into that. Let's just have a look at how they've been performing. So over the last 1 month, they're up, 6 months down by nearly 22, year to date, 1 year down, 5 years down. But if we max it out, we can see a little bit of a better picture here. And you can point out that they have been falling quite a lot recently. Well, we can ask ourselves why that may be. And I think this is just due to a variety of reasons in the current economic situation, but property valuations maybe. There'll be loads and loads of different reasons to explain this. But something that I wanted to point out with this company in particular is that part of its rental income is actually sort of governed by the government. So it's kind of secured in a way, as opposed to maybe some of the other REITs or other companies where their incomes are based purely on consumers and what they're doing. This one is based on properties for healthcare in the UK. So some of that income is secured by the UK government, hopefully anyway, which is obviously quite good in the current times. This company is in a relatively recession-proof sector, healthcare. And with the aging population increasing and people living longer, the services and the properties that this company is providing are going to be more in need than ever. So let's just start by taking a look at their top line. We can see that their total revenue has been increasing from 19 to 20 to 21, which is good to see. And then their bottom line as well, their net income, that has been increasing again each year. So that's very reassuring to see as an investor. We can see as well that their earnings per share have been increasing, and if we go over to their free cash flow, we can see a similar picture as well. Now the debt to equity ratio of this company comes in at about 0.84%. Like with PE ratios and things like that, this can be industry specific, so you need to look at the debt to equity ratio, what the company has been doing over time in their own ratio, and also compare that to other companies within the same industry. But 0.84 is a pretty good debt to equity ratio, and it's just telling us how the ability that the company has to actually pay off their debt. The debt to equity ratio of PHP is pretty good as well, coming in about 0.84. And you do have to compare the debt to equity ratio between industries. It's industry specific as well, just like with PE ratios, but that's a pretty good debt to equity ratio. And it's just telling you how much debt a company has per amount of equity that they have as well. So typically you don't really want the company's liabilities to be higher than their assets, just in general terms, and it's a bit of an indication of that. The last company to make it on our list today is Legal & General, an insurance company that I have in my own portfolio, and I'm sure many UK investors have this one as well. They have a dividend yield of 8%, which is very high and definitely higher than the average of the FTSE 100. This is a company with real brand recognition. People know Legal & General, and people know what Legal & General offer. And again, with the aging population increasing, Legal & General may become a little bit more in demand with retirement, pensions, insurance, and all of the other good stuff that they have to offer. Looking at their annual dividend increase, we can see that they too have been a pretty big powerhouse in terms of being able to increase their dividends year on year. We can see it if we scroll down here from 2012 onwards, they've been able to increase their dividends. Apart from in 2020, you can see that here, it looks like they kept it the same, which to me is still pretty impressive given, everything that was going on back in 2020. Coming to look at their stock performance here, 1 month they're up, 6 months up by about 0.5%. Year to date, again, up by not very much. 1 year, not so great, down by 8.85. 5 years, down by 6.8. And then we can max out here and we can see that it has been quite volatile here. And I think the reason that it's not been doing so great in the last sort of 1 year time period is just because when times are tough and money becomes a little bit more of a struggle, services that Legal & General have to offer may be ones that people actually decide to start cutting back on. Their PE ratio right now is about 7.5, which is actually lower than the average of Legal & General's PE ratio. So that could be indicating that now is a good time to buy this company should you want it. But PE ratios really don't tell you everything. Have a look at all the other things that you need to look at as well. Let's look at their top and bottom line first. So we can see that their total revenue increased between 2019 and 2020, but then it decreased slightly between 2020 and 2021. Net income, however, was able to increase every single year that we can see data for in front of us here. Going over to their balance sheet now, we can see that they have more in total assets than they do in total liabilities per year. So if we just look at 2021, you can see they have more assets than they do liabilities. One last thing to point out before we conclude is they're quite a cash-rich company. They have a lot of cash generation and their debt-to-equity ratio again is below 1 at 0.47. That was quite a quick run through of 3 companies that have not only a very high dividend yield, but also seem to be pretty decent companies as well. If you own any of these, let me know in the comments below. And if you want to add any particular pros or cons to any of these companies, again, I invite you to do so in the comments below. Don't forget to check out my Patreon in the description below. And of course, if you want one of these cool t-shirts, Eat, Sleep, Invest, Repeat. They come in 6 colors and I'll leave a link in the description too. Thank you so much for watching. I'll see you in the next one.